Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 3. And Chapter 3 is all about financial accounting and adjusting entries. And in today's lesson, there are five key areas that we're going to be discussing today. First, that would be the operating cycle. Second, we will also be discussing the adjusting entries. Third, we have the adjusted trial balance. Fourth, that will be using the adjusted trial balance to prepare financial statements. And finally, that would be the accounting cycle. Now, in order for us to get started, let us first discuss our first key area, and that would be the operating cycle. Now, take note that chapters 1 and 2 describe the recording and reporting of economic transactions in detail. However, the account balances used to prepare the financial statements in these previous chapters did not necessarily reflect correct amounts. Hence, chapter 3 introduces the concept of adjusting entries and how these satisfy the matching principle, ensuring revenues and expenses are reported in the correct accounting period. And the preparation of an adjusted trial balance is also discussed, as well as its use in completing financial statements. Now, financial transactions occur continuously during an accounting period as part of a sequence of operating activities, right? Now, for Big Dog Car Works Corporation, this sequence of operating activities takes the following form. First, we have the operations begin with some cash on hand. Second, cash is used to purchase supplies and to pay expenses. Third, revenue is earned as repair services are completed for customers. And finally, cash is collected from customers. Now, this cash to cash sequence of transactions is commonly referred to as an operating cycle, as you can see in figure 3.1. Now, as you can notice, this presents one operating cycle, okay? And for this particular example, the operating cycle, as you can notice, starts from cash on hand. Then, these cash were used by the company to purchase repair supplies. And aside from purchasing repair supplies, the company also paid its expenses, may it be their operating expenses or marketing and administrative expenses. They also make a cash payment, okay, of their payables to their suppliers. Since the nature of the business is a service type of business, they performed repair services for their customers, which resulted to accounts receivables, and then eventually they made collection on all the receivables they have from their customers. All right. So this is how an operating cycle would look like. But you have to bear in mind as well that an operating cycle is not uniform to all companies, okay? Because technically speaking, it may depend on the type of business you are in. And so, for that matter, an operating cycle can vary in duration from short, such as 1 week, for example, grocery store, or to much longer, such as 1 year, examples, a car dealership. And therefore, an annual accounting period could involve multiple operating cycles, as shown in the next figure. So, as you can see in figure 3.2, it presents sample operating cycles with an annual accounting period. As you can notice, not all the operating cycles in figure 3.2 are completed within the accounting period, right? Since financial statements are prepared at specific time intervals to meet the GAAP or generally accepted accounting principles requirements of timeliness, it is then necessary to consider how to record and report transactions related to the accounting period's incomplete operating cycles, and two gap requirements such as the recognition and matching principles provide guidelines in this area and are the topic of the next section, which happens to be our first key subtopic, recognition principle in detail. Now, GAP, again, the generally accepted accounting principles provide guidance about when an economic activity should be recognized in financial statement. Therefore, an economic activity is recognized when it meets two criteria. First, it is probable that any future economic benefit associated with the item will flow to the business. And second, it has a value that can be measured with reliability. Another subtopic, we have recognition or revenue recognition illustrated. Now, in order for us to better understand what is this, let us have a brief recap first on what revenue recognition is. Now, in our previous lectures, we happened to learn that revenue recognition is the process of recording revenue in the accounting period in which it was earned. And this is not necessarily when cash is received. Now, most corporations assume that revenue has been earned at an objectively determined point in the accounting cycle. Now, in order for us to better understand this, let me give you an example. So, for example, it is often convenient to recognize revenue at the point when a sales invoice has been sent to a customer and the related goods have been received or services performed. Now, this point can occur before receipt of cash from a customer, creating an asset called accounts receivable and resulting in this general journal entry, okay? So when cash payment is later received, the asset receivable is exchanged for the asset cash, and the following entry is made, which is this one. Now, revenue is then recognized in the first entry, the credit to revenue, prior to the receipt of the cash. And the second entry, which is this one, has no effect on the revenue, okay? So when cash is received at the same time that revenue is recognized, then the following entry is made, which is this one. Okay, so when a cash deposit or advance payment is obtained before revenue is earned, a liability called unearned revenue is recorded as follows, which is this one. Okay, now revenue is not recognized until services have been performed. Now, at that time, the following entry is made, so which is this one. Okay, so the preceding entry reduces the unearned revenue account by the amount of revenue earned. Now, the matching of revenue to a particular time period, regardless of when cash is received, is an example of accrual accounting. So what is meant by accrual accounting then? If we see accrual accounting, it is the process of recognizing revenues when earned and expenses when incurred, regardless of when cash is exchanged. It forms the basis of GAAP, and recognition of expenses is discussed in the next subtopic, which is the expense recognition illustrated. Now, remember that in a business, costs are incurred continuously, correct? Now, to review, a cost is recorded as an asset if it will be incurred in producing revenue in future accounting periods. A cost is recorded as an expense if it will be used or consumed during the current period to earn revenue. Now, this distinction between types of cost outlays is illustrated in figure 3.3. Now, as you can see in figure 3.3, it shows the interrelationship between the assets and the expense, okay? Now, in the previous section, Regarding revenue recognition, journal entries illustrated three scenarios where revenue was recognized before, at the same time as, and after cash was received. And similarly, expenses can also be incurred before, at the same time as, or after cash is paid out. So, an example, when expenses are incurred before cash is paid, occurs when the utilities expense for January not paid until February. So, in this case, an account payable is created in January as follows. Okay, so this is gonna be the journal entry. So the utilities expense is reported in January income statement. When the January utilities are paid in February, then the following is recorded, which is this one. Now, the preceding entry has no effect on expenses reported on the February income statement because expenses can also be recorded at the same time that cash is paid. For example, if salaries for January are paid on January 31st, then the entry on January 31st is this one, okay? As a result of this entry, salaries expense is reported on January income statement when cash is paid. And finally, a cash payment can be made before the expense is incurred, such as insurance paid in advance. So, a prepayment of insurance creates an asset, prepaid insurance, and it is recorded as this one. Okay? Now, as the prepaid insurance is used, it is appropriate to report an expense on the income statement by recording the next entry, which is this one. Okay? Now, the preceding examples illustrate how to match expenses to the appropriate accounting period. And the matching principle requires that expenses to be reported in the same period as the revenues they helped generate. That is, expenses are reported on the income statement first when related revenue is recognized, and second, during the appropriate time period, regardless of when cash is paid. Now, to ensure the recognition and matching of revenues and expenses to the correct accounting period, account balances must be reviewed and adjusted prior to the preparation of financial statements. And this is going to be the topic of the next section. So as you can see, our next key area that we're going to be discussing, that would be the adjusting entries. And at the end of an accounting period, before financial statements can be prepared, okay, the accounts must be reviewed for potential adjustments first. And this review is done by using the unadjusted trial balance. So what do we mean by unadjusted trial balance then? If we say unadjusted trial balance, it is a trial balance where the accounts have not yet been adjusted. Now, as you can see in figure 3.4, it shows the unadjusted trial balance of Big Dog Car Works Corporation at January 31st, 2015. As you can notice, it is an unadjusted trial balance because the accounts have not yet been updated for adjustments. And so for that matter, we will use this trial balance to illustrate how adjustments are identified and recorded. And take note that adjustments are recorded with adjusting entries. So what is the purpose of adjusting entries then? Well, the purpose of adjusting entries is to ensure both the balance sheet and the income statement faithfully represent the account balances for the accounting period. In short, adjusting entries help satisfy the matching principle. Now, as you can see in figure 3.5, it shows the 5 types of adjusting entries. And these are, first, we have adjust prepaid assets. Second, adjust unearned liabilities. Third, adjust plant and equipment assets. Fourth, adjust for accrued revenues. And finally, adjust for accrued expenses. Now, in order for us to better understand each of these, let us discuss them one by one, starting with how to adjust prepaid assets. Okay. Now, we have to be reminded that an asset or liability account requiring adjustment at the end of an accounting period is referred to as a mixed account because it includes both a balance sheet portion and an income statement portion as well. Now, the income statement portion must be removed from the account by an adjusting entry. As you can see in figure 3.4, it shows an unadjusted balance in prepaid insurance of $2,400. Now, recall that in Chapter 2, that Big Dog Corporation paid for a 12-month insurance policy that went into effect on January 1st, transaction number 5, correct? Now, at January 31st, 1 month or $200 of the policy has expired. If we say expired, it's been used up already. Okay, so it's calculated as $2,400 divided by 12 months. So that becomes $200. And the adjusting entry on January 31st to transfer $200 out of prepaid insurance and into insurance expense will be this one. All right. Okay, so this is our T account for unadjusted trial balance. And this is going to be the journal entry that I'm referring to. And this is going to be the final T account, the adjusted trial balance already. Now, as you can see, the balance remaining in prepaid insurance account is $2,200 after the adjusting entry is posted. Now, the $2,200 balance represents the unexpired asset that will benefit future periods, namely the 11 months from February to December 2015. And the $200 transferred out of prepaid insurance is posted as a debit to the insurance expense account, okay, to show how much insurance has been used during January. Now, if the adjustment was not recorded, then assets on the balance sheet would be overstated by $200 and expenses would be understated by the same amount on the income statement. Okay, so that is how we do adjustment on the prepaid asset. What about doing adjustment in unearned liability? Now here, on January 15, if you can recall, Big Dog Corporation received $400 cash payment in advance of services being performed. Out of 400, take note that $300 for January was received and another $100 received for the month of February. Now, this advance payment was originally recorded as unearned since the cash was received before repair services were performed. Okay. Now, at January 31st, $300 of the $400 unearned amount has been earned already. And therefore, $300 must be transferred from unearned repair revenue into repair revenue. And the adjusting entry at January 31st would be this one. Okay. Now, after posting the adjustment, okay, supposing we have already posted the adjustment, the $100 remaining balance in unearned repair revenue, calculated as $400 minus $300, represents the amount at the end of January, and that will be earned in February. And as you can see, if the adjustment was not recorded, unearned repair revenue would be overstated, meaning too high by $300, causing liabilities on the balance sheet to be overstated. Additionally, revenue would be understated, meaning too low by $300 on the income statement if the adjustment was not recorded. Okay, so that is how we do adjustment using an earned liability account. And the next key subtopic that we're going to be discussing, that would be adjusting plant and equipment accounts. Now, if we say plant and equipment assets, these are also known as our long-lived assets, and these are expected to help generate revenues over the current and future accounting periods because they are used to produce goods, supply services, or even used for administrative purposes. Now, in regards to this, the truck and equipment purchased by Big Dog Car Works Corporation in January are examples of plant and equipment assets that provide economic benefits for more than one accounting period. And because plant and equipment assets are useful for more than one accounting period, their costs must be spread over the time they are used. Now, this is done to satisfy the matching principle. Now, in order for us to better understand this, let me give you an example. So, for example, the $100,000 cost of a machine expected to be used over 5 years is not expensed entirely in the year of purchase because this would cause expenses to be overstated in year one and understated in years two, three, four, and five. And therefore, the $100,000 cost must be spread over the asset's 5 years life. Now, in order for us to better understand this, we need to talk or discuss about depreciation. So, what do we mean by depreciation? If we say depreciation, it is the process of allocating the cost of a plant and equipment asset over the period of time it is expected to be used. Now, the amount of depreciation is calculated using the actual cost, okay, and an estimated of the asset's useful life and residual value. So what's the difference between useful life and residual value then? Well, if we say useful life, it is an estimate of how long it will actually be used by businesses regardless of how long the asset is expected to last. For example, a car might have a manufacturer's suggested life of 10 years, but a business may have a policy of keeping cars for only 2 years. Okay? Therefore, the useful life for depreciation on purposes would therefore be 2 years and not 10 years. On the other hand, if we say residual value, it is an estimate of what the plant and equipment asset will be sold for when it is no longer used by a business. Residual value can be zero. So there are different formulas for calculating depreciation, but in this regard, we will be using the straight line method of depreciation. So as you can see here, this is the formula in calculating depreciation applying the straight line method. And our formula, that would be depreciation equals cost minus estimated residual value divided by estimated useful life. Now take note that the cost less estimated residual value is the total depreciable cost of the asset. Again, I would like to reiterate, your cost minus estimated residual value is the total depreciable cost of the asset. This means to say that the straight line method allocates the depreciable cost equally over the asset's estimated useful life. Now, when recording depreciation expense, our initial instinct is to debit depreciation expense and credit the plant and equipment asset account in the same way prepaids were adjusted with a debit to an expense and a credit to the prepaid asset account. However, crediting the plant and equipment asset account is actually incorrect. Why incorrect? Because instead, a contra account called accumulated depreciation must be credited. So what do we mean by contra asset then? If it's a contra asset or contra account, it is an account that is related to another account and typically has an opposite normal balance that is subtracted from the balance of its related account on the financial statements. And so, for that matter, accumulated depreciation records the amount of the asset's cost that has been expensed since it was put into use. Now, accumulated depreciation has a normal credit balance that is subtracted from a plant and equipment asset account on the balance sheet. So, initially, the concept of crediting accumulated depreciation may be confusing because of how we learn to adjust prepaids, which is debit an expense and credit the prepaid, right? Remember that prepaids, okay, they actually get used up and disappear over time. That being said, the plant and equipment asset account is not credited because, unlike prepaid, a truck or building does not get used up and disappear. And therefore, the goal in recording depreciation is to match the cost of the asset to the revenues it helps generate. All right. So, in order for us to better understand this, let me give you an example. For example, a $50,000 truck that is expected to be used by a business for 4 years will have its costs spread over 4 years. And after 4 years, the asset will likely to be sold. Okay, so the adjusting journal entry based on our example to record depreciation will be this one. Okay, so subtracting the accumulated depreciation account balance from the plant and equipment asset account balance equals the carrying amount or net book value of the plant and equipment asset that is reported on the balance sheet. Now, I'm quite sure that it's still a bit confusing on how it works. And so, for that matter, let's work through two more examples to demonstrate depreciation adjustments. So, in this case, Big Dog Car Works Corporation's January 31st, 2015 unadjusted trial balance showed the following two plant and equipment assets. So, you have there account names or account numbers 183 and 184 with its corresponding account name and the values as well. Now, the equipment was recorded as a plant and equipment asset because it has an estimated useful life greater than 1 year. Now, assume its actual useful life is 10 years. So that becomes 120 months if converted to months. And the equipment is estimated to be worth $0 at the end of its useful life, or that's gonna be residual value equals $0. And so applying our formula in getting depreciation, so that will be depreciation equals cost minus estimated residual value divided by estimated useful life. Now, as you can see, 3,000 was the purchase price of our equipment minus the residual value of $0, and our estimated useful life is 120 months, and therefore your depreciation is gonna be $25 per month. Okay, now take note that depreciation is always rounded to the nearest whole dollar. Why is that? Because depreciation is based on estimates, an estimated residual value, and an estimated useful life. It is not exact, in short. So the following adjusting journal entry is made on January 31st. So this is how our journal entry would look like. Now, when the adjusting entry is posted, then the accounts appear as follows. Okay, as you can see, this is how the accounts would look like. For financial statements reporting, the asset and contra asset accounts are combined, and the net book value of the equipment on the balance sheet is shown as 2,000 $2,975. Now, how did we get this amount? Well, the $2,975 is calculated as $3,000, which happens to be the purchase price of our equipment, less the $25 depreciation per month. Okay, so therefore, Big Dog Car Works Corporation also shows a truck for $8,000 on January 31st, 2015, unadjusted trial balance. So as you can see, they also purchased another asset, which is a truck worth $8,000. Now, assume that the truck has an estimated useful life of 18 months and a zero estimated residual value. Now, at January 31st, 1 month of the truck cost has expired since it was put into operation in January. So, using the straight line method, depreciation is calculated as, so you have $8,000, the purchase price of the truck, minus $0 residual value, divided by the 80 months estimated useful life, and therefore our depreciation is $100 per month. Now, the adjusting entry recorded in January 31st is this one. Okay, so this is how our journal entry would look like. Now, when the adjusting entry is posted, then the accounts appear as follows. So as you can see, for financial reporting or for financial statements reporting, the asset and contra asset accounts are combined, and the net book value of the truck on the balance sheet is shown as 7,900. So how did we calculate this? This is calculated as 8,000, okay, purchase price of the truck minus the $100 depreciation. So if depreciation adjustments are not recorded, then assets on the balance sheet would be overstated. Additionally, expenses would be understated as well on the income statement, causing net income to be overstated. So if net income is overstated, then retained earnings on the balance sheet would also be overstated. So that is why it is very important to note that land is a long-lived asset. However, it is not depreciated because it does not get used up over time. Like I mentioned earlier last semester, if you can recall, the only asset that will not depreciate is the land because its useful life is infinite. Okay, it's never ending. So it's not going to be used up. All right, so you have to take note on that. And the next key subtopic that we're going to be discussing, that would be how to adjust using accrued revenue. Now, if we say accrued revenues, these are revenues that have been earned but not yet collected or recorded. For example, a bank has numerous notes receivables, okay? Now, these notes receivables are basically their collectibles, may it be from private individuals or businesses who got a loan from them. Now, remember, banks and other financial institutions earn through interest income, right? And so for that matter, interest is earned on the notes receivable as time passes. Now, at the end of the accounting period, there would be notes receivable where the interest has been earned but not collected or recorded. And so the adjusting entry for accrued revenue would be this one. Okay, so this is how our adjusting entry would look like. So for Big Dog Car Works Corporation, assume that on 31st of January, $400 of repair work was completed for a client, but it had not yet been collected or recorded. And so a Big Dog Car Works Corporation must record the following adjusting entry through this. Okay, so this is how our adjusting entry would look like. And if the adjustment was not recorded, then assets on the balance sheet would be understated by $400 and revenues would be understated by the same amount on the income statement. And the next key subtopic, that would be adjusting accrued expenses. Now, just a recap, if we say accrued expenses, these are expenses that have been incurred but not yet paid or recorded. For example, your utility bill, okay? So supposing you received your utility bill, may it be your electric bill, your water bill, or telephone bill. So suppose you receive your utility bill at the end of the accounting period, is likely not payable for 2 to 3 weeks. Okay. Now, utilities for the period have been used already, but have not yet been paid or recorded. And so, for that matter, the adjusting entry for accrued expense would be this. Okay. This is how our adjusting entry would look like. So, how about if we do accruing interest expense? Now, as you can see in figure 3.6, it shows an example of interest incurred during an accounting period. Now, for Big Dog Car Works Corporation, the 31st January 2015 unadjusted trial balance shows a $6,000 bank loan balance. Okay. Now, assume it is a 4% 60-day bank loan. All right. Now, as you can notice, it was dated the 3rd of January, which means that on January 31st, 28 days of interest have accrued. So that's going to be January 31st less January 3, okay, equals 28 days. Now, the formula in calculating interest when term is expressed in days would be interest equals principal times interest rate times elapsed time in days divided by 365 days. Now, the interest expense accrued at 31st of January is calculated as $18, and this is rounded to the nearest whole dollar. Okay, now interest is normally, you might be asking, why is it divided in 365 days? Now, to answer that question, it is divided in 365 days because, take note, that interest is normally expressed as an annual rate, and therefore the 28 days must be divided by 365 days in a year. And normally, all interest calculations in this textbook are rounded to 2 decimal places. However, for simplicity of demonstrations in this chapter, we will round to the nearest whole dollar. So Big Dog Car Works Corporation adjusting entry on the 31st of January would be this one. Okay, so this is how our adjusting entry would look like. Now, this adjusting entry enables Big Dog Car Works Corporation to include the interest expense on the January income statement, even though the payment has not yet been made. And the entry creates a payable that will be reported as a liability on the balance sheet at the 31st of January. So when the adjusting entry is posted, the accounts appear as this one. Okay, so this is how the accounts or the T account would look like. Now on February 28, interest will again be accrued and recorded as this one. Okay, now this is how our adjusting entry would look like on the 28th of February, especially when interest will again be accrued and recorded. Now, on March 4th, when the bank loan matures, Big Dog will pay the interest and principal and record the following entry as this one. Okay, so this is how our journal entry would look like. Now, the $36 debit, okay, to interest payable will cause the interest payable account to go to zero, since the liability no longer exists once the cash is paid. And notice that the total interest expense recorded on the bank loan was $39 and $18 expense in January. So $18 expense in February and $3 expensed in March. Now the interest expense was matched to the life of the bank loan. And aside from that, We will now be moving on to how to accrue income tax expense. Now, another adjustment that is required for Big Dog Car Works Corporation involves the recording of corporate income taxes. Okay. Now, in most jurisdictions, a corporation is taxed as an entity separate from its shareholders. Now, for simplicity, assume that Big Dog Car Works Corporation's income tax due for the 2015th of January is $500. So the adjusting entry at January 31st, that would be this one. Okay, so this is how our journal entry would look like. Now, when the adjusting entry is posted, then the T account appears as follows. So this is how our T account would look like. And as you can see on the adjusting entry, it enables the company to match the income tax expense accrued in January to the income earned during the same month. Now, as you can see in figure 3.7, it represents or it shows the 5 types of adjustments discussed in the previous slides as summarized. Okay, so this is already the summary of the 5 types of adjustments that we just discussed earlier. All right, so the next key area that we're going to be discussing now, that would be the adjusted trial balance. Now, in the last section or slides, adjusting entries were recorded and posted, correct? As a result, some account balances reported on the 31st of January 2015, unadjusted trial balance in figure 2 have changed. And recall as well that an unadjusted trial balance reports account balances before adjusting entries have been recorded and posted. On the other hand, if we say adjusted trial balance, it reports account balances after adjusting entries have been recorded and posted. Now, as you can see in figure 3.8, it shows the adjusted trial balance for Big Dog Car Works Corporation at 31st of January 2015. Now, in chapters 1 and 2, the preparation of financial statements was demonstrated using Big Dog Car Work Corporation's unadjusted trial balance. We now know that an adjusted trial balance must be used to prepare the financial statements, which happens to be our next key area, which is using the adjusted trial balance to prepare financial statements. Now, in the last section or slides, we saw that the adjusted trial balance is prepared after journalizing and posting the adjusting entries. Now, in this section, it will show how financial statements are prepared using the adjusted trial balance. Now, as you can see in figure 3.9, okay, it presents the Big Dog Car Work Corporation's 31st of January 2015 adjusted trial balance, and it links among all financial statements. And take note that the income statement is prepared first, followed by the statement of changes in equity as shown in the figure. So as you can see in the left portion, all right, so that is where the adjusted trial balance of the company should be located. And as you can see on my right portion, the very first financial statement that was generated, okay, using the adjusted trial balance information was the income statement, okay? Because the result of the income statement can be found in the next financial statement, which we will be generating next. And that happens to be the statement of changes in owner's equity. All right. So as you can notice, the net income $2,057 was used by the next financial statement created, which is statement of changes in owner's equity. So we made use of that amount there in our next statement. And after statement of changes in owner's equity, the next statement that we're going to be generating, that would be the balance sheet. All right. So that is how we use the information of adjusted trial balance to generate our financial statements. And the last key area that we're going to be discussing now, that would be the accounting cycle. And basically, this is just a recap, okay? This is just a brief discussion of the different steps in accounting cycles. Now, recall that the concept of the accounting cycle was introduced in chapter 2, correct? And the accounting cycle consists of the steps followed each accounting period to prepare financial statements. And we also happen to learn this one in your accounting 1 subject last semester. And the 8 steps, general steps in accounting cycles, that would be first, of course, transactions should be analyzed first. And after having analyzed the transactions, when we say analyze the transaction, we need to see to it as to which accounts are involved in our transaction. So once we have identified the different accounts that are involved in our transactions, then that's going to be the time that we record that one in our general journal. So that's step number 1. Now, after having recorded that in our general journal, the second step, the journal entries in the general journal are then posted to the accounts in the general ledger. Take note that the general journal is considered to be as the first entry or the book of original account, because that is where the first entry happens or recorded, okay? And the general ledger is the final book, because that is where the entries from your general journal are being posted. And step number 3, an adjusted trial balance is prepared to ensure total debits equals total assets. So that is what we discussed earlier. We provided examples of unadjusted trial balance using the information of the Big Dog Car Works Corporation. And step number 4, the unadjusted account balances are being analyzed and adjusting entries are journalized in the general journal and posted to the general ledger. So the unadjusted, we made adjustments on it using the adjusting entries. And that's going to be step number 5. The adjusted trial balance is prepared already to prove the equality of debits and credits. And after that, the adjusted trial balance is used to prepare financial statements, the one that we discussed earlier. And then step number 7, we need to close the entries, and closing entries are journalized and posted, and then preparation of a post-closing trial balance. All right, I think that's a good place to stop. If you have questions, please let me know in the comment section below. If you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.